My name is Nayoni and my teammates are Rutuja, Trisha and Vanshita. Our topic is green bonds and sustainable investment. What are green bonds? These are financial instruments that are used to raise capital for projects that have a positive environmental impact. Since their global inception in 2007, green bonds have become a key tool in financing sustainable development. These attract the ESG focused investors, they lower the borrowing costs and enhance reputation. The green bond market has grown rapidly worldwide, with Europe, the US, and China being the largest markets. India's market is also growing fast, becoming a key player in Asia. India's green bond market took off in the year 2015, with key issuers being Yes Bank and IDBI Bank. As you can see in the table, the number of issuances in 2015 were only 2, but as of 2023 it has grown to 11. And India has issued over USD 20 billion in green bonds, positioning itself as one of the leading markets in Asia for sustainable finance. The funds raised through these bonds have directed towards renewable energy projects, sustainable infrastructure, and other environment friendly initiatives. For instance, renewable energy accounts for nearly 60% of the total green bond proceeds in India, underscoring the nation's focus on transitioning to a low carbon economy. To explore this further, we have conducted two detailed case studies on IREDA and SBI, both prominent players in India's green bond market. These case studies will provide insights into how they are utilizing these bonds to finance a project.
Green bond by SBI was issued in about 2018, the first green bond, raising up to 650 million US dollars. This bond was oversubscribed and demonstrating strong investor confidence. Then again, another issuance was made in 2021, where about US dollars 300 million was raised and under its USD 10 billion global medium term note program. These were some of the issuance details and investor distribution details. These are the utilization of funds and performance metrics, environmental impact. The leverage ratio debt to equity was about 4 times. Interest coverage ratio was, or EBIT, was at least by 2.2 times, and return on assets was about 4.8%, and return on equity was about 11.8%. Green bond index performance was an addition of 3.0% annual return. SBI successfully raised about US dollar 650 million with net proceeds of US dollar 645 million after issuance cost, reflecting on the efficiency and appeal of this offering. The capital will be deployed exclusively in financial environment sustainable projects, furthering the mission to promote a greener and more sustainable future. The yield spread of these bonds was quite competitive, standing at about 180 basic points over US Treasuries and 140 basic points over Indian government bonds. The post-issuance of the debt-to-equity ratio stands about 4.2x times, a figure that demonstrates the strategic leverage while managing and maintaining a disciplined approach to the financial structure. Furthermore, with an effective bond duration of about 4.8 years and a convexity of measure of 1.08, the sensitivity of these bonds to interest rates changes remains well within a manageable limits, ensuring both stability and attractiveness to investors. Finally, a post-issuance liquidity ratio of about 130 underscores the ability to meet short-term obligations while continuing to drive forward the sustainable initiatives. Building on this, uh, let's talk about the green bond premium or green name. These bonds carry a premium of about 8 basic points over conventional bonds. It is a clear indication of the market's recognition of value and importance of investing in sustainable products. We must consider the interest rate of risk here associated with these green bonds. With a modified duration of about 4.6, these green bonds exhibit controlled sensitivity to interest rate changes. The metric reassures investors that their exposure to potential rate fluctuations is effectively managed, providing a stable in a dynamic financial environment. Additionally, a convents associated with these bonds include restrictive clauses designed to limit higher risk investments. These convents ensure that the funds raised are used exclusively for their intended purpose, supporting a low-risk environment sustainable projects. In conclusion, these metrics collectively present a compelling case for SBI's green bonds.
Coming up to the case studies on green bonds and sustainable investment by the Indian Renewable Energy Development Agency, the IREDA. The IREDA had issued green bonds amounting to over $300 million, and after covering issuance cost, the net proceeds stood at $297 million. These bonds were primarily aimed at financing renewable energy projects, including solar and wind power, contributing significantly to India's renewable energy goals. IREDA's bonds exhibit a green bond premium or greenium of 10 basis points, indicating the market's positive reception to the sustainable finance. With a post-issuance liquidity ratio of 1.25, the IREDA shows a healthy ability to cover the short-term obligations, and the modified duration of 4.5, it highlights the bond's interest rate risk, while restrictive covenants provide protection to the bondholders by limiting additional debt issuance. These were the detailed analysis of the IREDA bonds. Moving on to some of the key features of the IREDA bonds, the issuance size of IREDA was first a green bond issued in 2017, raising $300 million, and after covering issuance costs, the net proceeds stood at $297 million. With a maturity and interest rate of 5 years, the bond had a 5-year maturity rate and an interest rate of 7.125%. The use of proceeds and environmental impact were as follows. The project financing was used to raise, and it was primarily used to finance wind, solar, and small hydro projects. By 2020, the IREDA had financed over 2,700 megawatt of renewable energy projects through these green bonds. And the environmental impact of the projects were that the project was financed and estimated to have reduced approximately 2 million tons of carbon dioxide emissions annually. The statistics on the market performance are as follows. The IREDA's green bonds received a significant oversubscription of 1.7 times, showing how significantly the investment in green bonds has increased. The green bonds were significantly oversubscribed by 1.7 times with a debt service coverage ratio of 1.35. The post-issuance DSRC stands at 1.35, indicating the agency's capacity to meet its debt obligations, and the debt to equity ratio was increased to 3.7x times. The coupon payment frequency. The bonds have a semi-annual coupon payment structure with a convexity. The convexity has the measure of the bond price sensitivity stands at 1.05, and the green bond premium or the greenium, the bond exhibit a green bond premium of 10 basis points, indicating the market's positive reception to the sustainable finance. And the interest rate risk, the bond's modified duration is 4.5, indicating a 4.5% price range for a 1% change in the interest rates. With respect to the restrictive covenants, these bonds include covenants that limit additional debt issuance without the consent of the bondholders, providing added protection. In conclusion, the IREDA's green bonds have successfully attracted significant interest, with their issuance contributing to the development of renewable energy projects in India and supporting the country's sustainable growth objectives.
Good afternoon, sir. This is Trisha. So, coming to IREDA green bonds, IREDA means Indian Renewable Energy Development Agency. IREDA green bonds exhibit a convexity of 1.05, meaning moderate price sensitivity to interest rate changes. The positive issuance liquidity ratio stands at 1.25, reflecting sufficient asset coverage over liabilities. The green bond premium is 10 basis points, indicating a slightly lower yield than conventional bonds due to its environmental focus. The modified duration of 4.5 signifies that bonds price will change by 4.5% for every 1% change in the interest rate. Restrictive covenants prevent IREDA from issuing additional debt without bondholder approval, reducing risk for existing investor by limiting excessive leverage. Coming to the next slide, key financial matrices. Here, IREDA green bonds offer a yield premium of 200 basis points over US Treasuries and 150 basis points over Indian government bonds, providing competitive returns. The post issuance leverage ratio of 3.75 times indicates moderate financial leverage, signaling that the company can manage its debt with a comfortable cushion. Investors benefit from semi annual payments, ensuring consistent cash flow. These matrices reflect a balance between risk and return, with the bonds offering higher yields compared to government securities while maintaining manageable leverage and providing steady income to bondholders through regular interest payments. The additional financial matrices of IREDA green bonds reveal strong financial health. A current ratio of 1.35 indicates adequate short term liquidity, while the quick ratio of 1.20 shows efficient asset management without inventory reliance. The cash flow coverage ratio of 1.5 times signifies sufficient cash flow to cover debt. A free cash flow yield of 6.5% and price to earning ratio of 10x reflect solid valuation. The IBETDA margin, ITDA meaning earning before interest, tax, depreciation, and amortization. The margin of 55% indicates strong profitability with a net profit margin of 25%. A ROCE of 18% demonstrate efficient capital use. The bonds carry a 20 basis points sovereign risk premium and ESG score of 85% and CDS spread of 150 basis points, signaling creditworthiness. Competitive insights. IREDA and SBI are key players in Indian green bond market. IREDA focusing on long-term renewable energy projects and SBI targeting sustainable infrastructure. IREDA bonds offer moderate leverage and long duration, while SBI provides more frequent quarterly returns. Both bonds involve high risk and returns, highlighting the need for tailored investment strategies. To boost green bonds issuance in Asia, policy recommendation include tax spillover to increase investor returns and subsidies during early project stages. These measures could enhance the appeal of green bonds, aiding in climate change mitigation while supporting sustainable growth in the region. Thank you, sir.